everyone, and a warm welcome to this another series of the Principal Connect program. In this series, we meet our fund managers and we take their views on the market and their recommendations. And today, I have with me Mr. P.V.K Mohan, our Head of Equities, to share his views on the market now post-election results. So, welcome Mohan in the Principal Connect program.
Thank you, Gaurav. Pleasure to be here.
So, Mohan, we had a big event, which has recently happened, and now post-election, we have government with this massive mandate. So, how do you see? What are the implications in the market on the economy, on the policies after this, massive mandate?
Yeah, so I think it's been a historic mandate. What it means for the equity markets, I think, is most importantly the continuity. The continuity in policies, the approach to the economy, consistency, and some kind of continuity is very important. I think this mandate ensures that there is stability of policies. So that's very important for the market, and in the near to medium term, the market is guided by sentiment. And I think this will be, this historic mandate will go a long way in contributing to a positive sentiment, not only among the local investors but also among foreign investors.
Okay.
So I think that's the most important part. I think the second part of it is really from here on, since it's the same government, incumbent government coming back, what the market would watch for here on is what are the measures to address growth, which is flagging a little bit at this point of time, and measures to address some of the rural distress that we're seeing in several pockets at this point of time. And there is an expectation that while doing this, you not only address some of the issues that have been plaguing the economy, but probably once the government gets back to normal business as usual, we should see better economic growth momentum, say after a lag of a few quarters. Okay. So I think what it means therefore is continuity, hopefully better growth momentum in the economy, and therefore it follows that therefore corporate earnings growth will also get onto a better sustainable growth trajectory.
Okay, but if you look at the trinity which has been talked in the market of sentiments, valuations, and earnings. So while sentiment has become much more positive, in terms of valuation, we continue to be expensive. In terms of earnings, it has been disappointing, earnings every year, and we talk about next year earnings expectation. So with sentiments being positive at this side, but valuations being stretched, earnings, disappointments, how do you see that happening now?
Okay, I think first thing is the outlook for FY20 earnings is reasonably positive. I think in some part you could say it comes from a low base effect of FY19.
Okay.
So that sets the base for a reasonably strong earnings growth into FY20. I think the market buoyancy is really the fact that once the economy gets back to a better growth trajectory, earnings can follow.
Okay.
Some of the things that have been bogging down, or some of the sectors that have been bogging down earnings over the last few years, probably will not face those headwinds that they've faced in the past.
Okay.
So that's very important for the sustainability of earnings growth. So I think that's really from the earnings growth part of it. So we would expect a lot of the domestic oriented sectors to witness reasonably good earnings growth going forward.
Okay.
So that's it. On valuations, yes, I think given that we are just a tad below 20 times FY20, it's not a cheap market. It's not terribly expensive. I think whether India sustains these valuations will really depend upon the earnings growth outlook in FY20 and beyond. And I think measures that the government takes to get the economy back on track and push it onto higher growth trajectory, which could yield results with a lag of 4 to 6 quarters, can provide that visibility of growth. So if you do get onto a better earnings growth trajectory, like strong double-digit earnings growth, we could see multiples remaining slightly elevated. what it also means is that these valuations, if you look at the large cap stocks, it also means that a greater opportunity now moving away from the top 100 stocks or the large cap stocks, because there are good businesses growing reasonably, trading at much lower valuations than the large cap peers. And I think what this market and this election result does provide is a greater focus on those type of companies, which have suffered a lot in the last year and a half. So I think the market therefore would gravitate towards those category of stocks and not distinguish purely on the market cap basis. So that's going to be an important change.
So in this perspective, which sectors do you expect to play out in 2019 and onwards?
What we call the domestic cyclicals.
Okay.
So sectors which are more oriented towards the domestic economy, sectors which benefit from better economic growth momentum going forward. So if I have to take some name, financials would be one of the most obvious names.
Okay. Both retail and the corporate
yes,
side?
I think the retail has been growing, would continue to grow, but the corporate in the near term would face more tailwinds for growth, given that they're coming off a low base.
Low base effect.
So that I think is one. I think sectors such as cement, for example, which is a play on housing and infrastructure, would probably, and given that this government has focused a lot on infrastructure and will continue to focus, so
that's part of their Sankalp.
Absolutely, that's part of their mandate.
Manifesto also.
Manifesto, so they've said that, highlighted that.
Correct.
So I think we see cement and construction, which would be the better ways of playing the whole infra theme. Maybe not so much the asset owners, but these are two sectors which could continue to do extremely well going forward. We are also continue to be bullish in terms of the export-oriented, the chemical sector, especially the specialty chemicals. I think we've continued, that's one pocket of strong growth that we've seen when we see the latest quarter results also. And we expect that growth to continue. So that will be a sector to grow. Otherwise, on the domestic side, I think select industrials, some of the services sectors such as hotels, telecom, I think these are some of the other sectors where we see reasonably good. I think consumption, which is now taken a bit of a slowdown in the latest quarter, we do expect that with a quarter or two later, that growth momentum to pick up. So I think we are selectively positive on the consumption theme too.
Okay, fine. And Mohan, if you look at from 2015 to 2017, so we had mid caps and small caps outperforming the large cap. But in 2018, we saw large caps, albeit a concentrated rally in the large cap, outperforming the mid caps. So now, how do you see in 2019 in terms of which market cap is going to outperform? And
okay, I think one thing we strongly believe is 2019 will be a year where we would see much more broad-based performance. Okay, so when I say broad-based, I mean in terms of the number of sectors which will participate in this uptrend.
Correct.
The number of stocks which will participate in this. I think as you very rightly highlighted, 2018 was a year of large caps, but it was even within large caps, very concentrated rally which we saw probably after 2006. It's after 12 long years we've seen such a concentrated rally. So we even within large cap we expect it to be much more broad-based. But I think the most striking thing I think would be that probably the return of mid and small cap stocks in terms of correcting their strong underperformance that we've seen over the last 1.5 years. So good companies in that space with reasonably good visibility, reasonably good growth and valuations which are supportive, I think over the next 3 years would probably outperform some of the large cap peers. So that's going to be one significant shift, and I think that is something that also aids to the market momentum. When you see a greater number of stocks participating, it gives you that breadth and more confidence in the sustainability of the market.
Okay, so you are talking about in terms of mid caps and small caps outperforming the large cap, and also in terms of the rally, you are saying it's going to be much more broad-based and much more wider participation. So, given that outlook and perspective, which are the product strategies which you would recommend, to clients and to our advisors to when to look at the incremental equity allocation?
I think from a fund perspective, clearly funds which have the mandate to invest into mid and small cap stocks would probably do better. So from the product portfolio, clearly the multi-cap strategy, which has the flexibility to move across, straddle the entire market cap space depending on opportunities. So I would expect that product to do well. So you could choose between a very concentrated 30 stock strategy, which is a focused multi-cap strategy, which I think, while today is probably about 75% large cap-ish, I would think that over the next few months, the allocation to mid and small caps probably would increase.
On the focus multi-cap, which is a concentrated strategy.
It's a concentrated strategy.
And then other strategy which you have is the flexi-cap strategy.
The other strategy, which is the multi-cap growth or the flexi-cap strategy, it's much more dispersed in terms of number of holdings, spread about 50 to 60 stocks.
Diversified,
much more diversified. So that's another strategy. So which probably, again, today is about 40% mid and small caps approximately. But probably that figure too could rise over the next.
So that will increase over the months.
I do see greater allocation towards mid and small cap. So these are the two product categories which in the multi-cap strategy. We also have the emerging blue chip, which is the large mid. So I think that's probably almost about 2/3 or a tad bit lesser than that into mid and small cap space. So these are clearly three distinct ways of approaching or playing the expected outperformance of mid and small cap strategy. I think for the slightly conservative investors, we have the hybrid fund, which is we are around 70% invested in equities, but even within that 70%, probably around 25-30% of that is invested into mid and small caps of the equity exposure.
Of the equity exposure.
So
which is 15%.
Absolutely, 15-18%. So which is again, I think, a reasonably decent exposure to drive some kind of alphas in that. So I think that would appeal to a relatively more conservative investor compared to the pure equity type of products. And I think we also, of course, have the principal small cap fund, which is very, very leveraged to this whole small cap rally. If it does play out the way we envisage things, it's obviously one of the best ways to play the small cap opportunities in that space. So that's really for the slightly more risk takers, I would say, who willing to tolerate short-term volatility, but who have the patience to hold on and who therefore, could look for probably better returns in that. And I must, to complete this conversation, I would like to still highlight the principal balanced advantage. While it looks like a much more sober, very, very cautious strategy, I think the beauty of this product comes if you're willing to invest. It's a separate category, I think, by itself.
Separate asset class.
Absolutely, by asset class, since it's an asset allocation product. So it follows the P formula. Over the life cycle, I think simply it loses you very little money in bad times. It makes you reasonable money on the upside. So when you look at it over the life cycle of a boom and a bust kind of in the market, you end up making reasonable returns. So I think it often gets clouded in this when you see strong positive sentiment, but that's in separate asset class by itself. So that's the other thing, which tactically it's large cap oriented, but tactically we do take some mid cap exposure there also.
Sure. So thank you so much, Mohan, for your thoughts and views. So multi-cap is what your prime recommendation is. Increase allocation in mid and small cap funds. That is your recommendation which has been there. So thank you so much for your views, and I wish all our investors and partners happy investing with this thought.
Thank you.
Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.